there are in realms of buying anything with credit, there's a lot of um, different systems or mechanics that kind of go into place with it. So when people are shopping, they're going to typically hear about their TransUnion. They're going to hear about their Equifax, right? And they're going to hear about their Experian. Now, depending upon who you buy from or what you buy will dictate how you finance. For instance, TransUnion. You would use a version 4 or version 8 for financing through Nissan Motor Acceptance Corp. If you are doing a credit card, you're more than likely going to be going through Equifax or Experian. But within those systems, there's models, right? The two ones that get talked about most are FICO and your Vantage score. And so, outside of just having a score, you have to fit within a model that also scores you as well. And so, there's a reason why TU TransUnion has like 8 different versions, a TU8 versus a TU bar versus a 1, that you can select from, and they're all different things. And so when you say, "Oh man, when I bought my car, I was a 740 credit score," but when you pull up your FICO, you're a 620, it's because in the FICO model for buying a home or doing a credit card, that's how you score out. Your auto enhanced credit might be significantly higher because that's the bureau that they pull off of, or the version they pull off within the bureau. Um, but it gets really messy. And so you say, well, shit, how do I know what my score is? If I pull up my Credit Karma, right? My Credit Karma is going to say that I'm a 740. If I pull up my Chase account and do my Chase credit journey or whatever, it's going to say I'm a 640. If I pull up my Cap One, it's going to say I'm a 690. If I pull up my TU through my Equifax account, it's going to show that I'm a 710. And so it's hard to know where you sit all the time with your credit when there's different kind of variances that go into it. So really it's important to understand what impacts your credit the most. Now I will say that with the some of the things that they've come out to, of course, monetize, right? Um, there are some important things to know. You don't ever have to pay for credit in terms of pulling the credit. And the reality is that you get one free pull every year. It's actually through one of the regulations that allow you to have that. And you can know what your scores are from each bureau. Now, the cool thing with it is that if you do decide to pay money, right, and this isn't an ad, by the way, through Experian, you can do what they call the Experian Boost. And so you can report things that are non-credit earning as credit earning activities. And what I mean by that is if you have a static bill that you pay every month, a utility bill, a phone bill, etc. These previously you used to not impact it, but with Experian Boost you can do that. And so there's a lot of different tools you can do it. Obviously, if you've got challenges on your credit, you can pay them off. You can dispute things on your credit. You can do a rapid rescore. There's a lot of mechanics that go into it, but the important part is to understand that you have 3 bureaus, and within those bureaus, you're going to have different models. And really, the FICO model is what a lot of people go through for home mortgages. Currently, your baseline FICO has to be a minimum 620 without any specialized program. Really, 640 and higher is kind of the standard, but there are programs that allow you to do it. If you're looking for something specific in terms of program, obviously the higher score you are, the more qualified you'll be for certain options out there. Of course, no down payment, stated income loans, anything under the sun with it. Now, the other part of that really that goes into your credit score, and this is where people get really mixed up because if you had a parent who made you an authorized user, if you had a parent who put you on a credit card, made payments for you, if you had a parent that associated with you with credit and it wasn't necessarily yours, it'll show you as authorized user, potentially have the C on there if you're a co-signer. But banks look at payment history. Well, your credit relies on payment history just as much as everything else. And so when they look at it and they say, oh man, this is phenomenal pay history, but you're only an authorized user, your score doesn't really hold nearly as much weight as you think it does. Now, it does qualify you for a lot of things because when you're applying for high interest credit cards, when you're applying for, payday loans, whatever it is, they don't particularly care about the depth. They just want to make sure that you have a qualifying score so they can sell you whatever product they're going to do that's typically not going to be advantageous for you. Anything that they give you easily with no credit depth is usually going to be a high interest commodity that you're paying for. But payment history is super important. And so kind of going back to it, the things that impact your credit in terms of payment are going to be car notes. They're going to be personal loans. It's going to be credit cards, your revolving credit. It's going to be, if you by some circumstance have an additional lien on there that you've accounted for. If you've paid for, I think I said cars already. Those are things that contribute typically to your credit score with it. Now, again, depending on what bureau, if you do have the Experian boost, etc., there'll be some additional attributes that go to it. And so things that impact your score or can impact it is if you pay things off too quickly. So if you buy cars and you pay them off in 3 months of purchasing them, when you go to apply for a car loan, that lender is going to look at that and not typically view that positively. And really, because no different than anything else, it costs a lender to originate your loan. It costs a lender to put up the money to help you purchase the vehicle. Interest is their form of profit. It's also a risk assessment too. So that being said, when you pay off vehicles quickly, it does show your ability to pay off things quickly, but it also shows that you're not going to help the banks be profitable, which they'll score negatively. Wild, I know, right? The system is not designed for you to be most effective with your money. It's to be most effective with your money that makes them the most profit. So payment history is super important. Paying things over a year. If you can show that you pay on accounts for over a year, that's typically going to score well in approval process and with your credit profiling. If you have revolving credit, it's super important to acknowledge that revolving credit functions in a very unique way in that you can have your credit, you can have your limits. If you hit your limits on one and you have one account 0, that's not good. Even if it gets your score a little bit higher, you'll still score poorly through some programs because all you're proving is that you're not using one of your cards to try and mitigate your balances, but it's showing that all your other accounts are maxed out. That's not a good reflection of actual credit usage. That's just showing that you are trying to kind of game the system in terms of the scoring with it. So acknowledging that paying off credit cards is important. Now, it's okay to have a small balance. Obviously, you don't want to pay interest on those things, but in terms of it, having your debt utilization on your credit cards low is good. And really, even if you use them, you just want to make sure that come time every month that they're paid off or that they're significantly paid off, so you've got that availability there. Because having that availability means you haven't, in terms of how the banks view it, you haven't stretched yourself. You haven't put yourself in a situation that you can't handle. And of course, it's going to increase your score. And so people sometimes get this conception that if I keep one card low and I have the rest of them high, I'm okay. That's not true. In fact, revolving credit's going to be the most impactful in terms of your daily score than anything else out there. And it's just simply because it happens most frequently. Your ratios can vary more frequently. They can go up and down faster with it. And when people look at this, they want to make sure that you're capable of making informed financial decisions with it. So understanding the revolving credit is super important. You can do a lot of credit monitoring in terms of it. I guarantee you when I get a change in my credit bureau, I get 8 different notifications. It's good to know if I'm using my credit cards. I always try and monitor my balances that come with it and make sure that if I do jump into that I'm making smart decisions. The other thing you can do, of course, is if you have like a 0% card or a balance transfer to make it easier, you can balance transfer one card and just pay it off that way. There's some unique mechanics you can do to try and minimize how much you actually pay in interest, and of course, really what your credit reflects in terms of those payments with it. The other thing too is that installment credit is super important. Now, installment credits can be things like home note, they can be car notes, personal loans, etc. And really, installment credit's important because it shows that you're able to take larger sums of money and pay them off. And so if you are looking to establish credit and not pay through the nose, car credit's probably going to be the most obtainable and have the most access in terms of tools available to get it. I'm not saying you go buy a car to establish credit, but it is a solid way to get a good, decent credit profile without paying too much. Now, you could technically go take out a personal loan through your credit unions if you're going to use it for something, try and account for those, pay it off quickly. In some instances, just making those decisions to get to the next step. Credit variety is another one you'll see when they have these scoring systems. If you just have 20 credit cards but no installment credit, that's not going to necessarily reflect good for lenders. If you have only installment credit, no revolving, that's also not good for lenders. And really, you need to have that credit variety that comes with it. More so to let people know that you're capable of functioning financially at every level when it comes to making those decisions. Because when you go into it, it gets measured to it. Now, what people don't necessarily weigh on is the negative stuff. This is going to be things like your charge-offs. And we'll get into what that is in just a second. If you have bankruptcies, hopefully bankruptcies, right? If you have liens or tax liabilities, if you have, default accounts or collections. These are all things that go into impacting your score. Now, the good thing is that there's a huge variance from your charge-offs to your bankruptcies to your default and collections. And so knowing difference between a 13 and a 7, right? And knowing the difference between those is helpful. Now, we'll get into the easiest ones first, collections. You can have all sorts of types of collections. You can have your medical collections. If you have a rental collection, right? If you had a property that you charged off or left early, broke lease, whatever. If some service is coming after you for financial return, we'll just call it cell phone, right? They can technically put those collections on your credit. Now, the great thing is that you can either pay those collections, get them removed. You can challenge, depending upon the situation of the collection, you can challenge those collections and get them removed off your credit. Or, of course, you can reach out to the debtor, the collector, and see what you can work out in terms of getting removed. Collections will impact your score to a degree. They aren't the end-all be-all of you won't be able to get a house or anything else if you have them. So medical collections are the most common. A lot of them, people don't realize that they have the medical collections coming. They usually think their insurance takes care of it. Very easy to get removed. Call in the hospital to get it managed with it. Obviously, there's some gray areas if you actually do owe the money versus if it was just a misstep on that. Happens all the time. This isn't a slight against hospitals, the medical system, even though it's dramatically problematic in its own sense. But things to be mindful of. Rentals. This is one that I've seen it's very state to state. You can run into a lot of problems depending upon what state you're in with it. I can tell you a lot of rental companies that do try and pursue debts on credit get highly disputed, and it's simply because it's never when these happen, it's not an amicable way that it was left. So if the renter left on weird terms, if they try to do a 3-day eviction, which in Texas they can put the notice up, legally they can't enforce that. Those would be things that prompt it. If any of the situations that would potentially give you a reason to dispute that rental collection can happen there with it. And then of course, cell phones. I just said cell phones, but it's not uncommon if you leave service or carrier providers or something happens there. I'm not to say that you don't owe the money, but you should always challenge and send them letters with it, just to make sure that the debt is real and that it's owed. And if you owe debts, pay them, of course. It's super important to pay back any money that you borrow with it. But there's also a reality that companies are just as scandalous as consumers are when it comes to this type of stuff. So, charge-offs very similar to collections. If you had an account, personal loan, whatever it was, and you didn't complete that, after a certain time of default or delinquency, the account gets charged off. Now, those will stick with you for minimum of 7 years. And then, of course, if there's something done to renew that time period, that charge-off could go longer. So in the instance of, let's say you charge off a personal loan that was a debt consolidation. We don't know the reason why. If you reach out to that borrower and ask for clarification why it was charged off and you weren't delinquent, that's one way to dispute it. If you did charge it off, you can always settle with them for a lower amount. It'll change the status of the account, but it'll also say settled for less than what was borrowed, or it'll just sit there. And the reality is that charge-offs, again, will not prevent you from making business happen, but they do get levied against you pretty harshly in terms of buying houses. Even in the licensing process for an LO license, charge-offs get levied against you pretty hard. Anything that has financial obligations to it, they review this information, will always come up in conversation with it. So no, it can impact you professionally if you ever got into the finance game or do something with it. Doesn't mean you're a bad person. Charge-offs happen for all the right and wrong reasons. I can tell you that one of the biggest problems kind of in lineage generally is that you can run into a lot of unintentionally predatory lending just by being in the wrong spot right at the wrong time. You know, if you do a debt consolidation, or if you're doing a personal loan and they're giving you 5%, and then you sell them as debt consolidation and they move it to 18%, you've already committed to it, you're in a bad spot, right? And so that happens a lot with institutions, and so just be mindful of it. Obviously, there's gray area, there's right, wrong, and everything in between, and so knowing those things that come with it. And then, of course, bankruptcies. If you're in a bankruptcy, you'll probably have more than enough clarity on how they function. For those of you who haven't participated or maybe haven't been in one in a while, the type of bankruptcy will dictate really how your life goes for the next couple of years. Bankruptcies, again, are not a bad thing. They exist for certain purposes. Do they get abused? Yes, more than likely. But no different than it's just another tool in the system that allows you to function with it. If you do have a bankruptcy, just be mindful that when you're applying for a mortgage, if you are trying to qualify for certain programs and the bankruptcy is recent enough, for instance, VA, FHA, they have to be a minimum of, I think, 3 years discharged. That's 13 discharged, and 7, I think, is 4 years. You have to be super mindful of those things that come with it. Now, there's a difference between a dismissal and discharge as well, and of course, what it is. So, if you do get into bankruptcy, you're going to have a guarantor. You're going to have a letter from your guarantor, and it's going to be court ordered for the most part, and they're going to dictate really the availability of your assets and what you can do with those things when you decide to do them. So, if you were to buy a car while under bankruptcy, you have to have a letter from your trustee that tells you what you can and can't do. It has to be signed off typically by the judge that's handling it, and then of course you can't exceed those limits that come with it. Now, depending upon if you are liquidating all your assets in order to account for those debts, or if you're able to resolve those through a payment plan, again, drastically changes how it functions, but also impacts your credit too. Now, the good news is that once bankruptcies are paid and adjusted for, assuming you don't let anything else go to the wayside, your score shoots up pretty quickly, and more often than not, you can kind of talk through it. So, the first couple of years I was in the car business, because they were still recovering from kind of the '08 crash, we saw a lot of this, and I'll tell you, it's insane to see how much a person's pride is impacted when they have to discuss doing a bankruptcy. It's not a bad thing. It doesn't make you a bad person. I mean, it might if you're abusing the system, right? But the reality is that we all do it, and we have to really go through those processes to try and understand what it does. But we saw a lot of this, and so really understanding bankruptcies is important. Hopefully never get into them. Knowing that they're good tools to help maneuver bad financial situations is important, but they're not a get out of jail free card, and you don't owe any money to anybody. So last one's kind of tax liens. These vary if someone has a mechanics lien on something, if someone puts a tax lien due to back taxes, whatever it is. They can vary kind of the degree that you deal with them. They're not fun, and those things will haunt you for a long time. So definitely remedy those. If you ever try and get into a situation of buying something, you will be questioned about it. You will need a letter of explanation, and you will need to be able to kind of talk through it. And if it's not savvy, if it's not copacetic, more than likely you're not going to see a way to get approved with it. It's not to say it's impossible, but the likelihood of a lender accepting that additional risk, knowing that circumstance, they don't want to mix with it. And a lot of your loan programs, your Freddies, your Fannies, etc., are all federally regulated. So you have a lot of stuff that goes through with those things. So that's just kind of I don't want to say quick breakdown of credit, but really kind of a dumbed down explanation of it. Obviously, payment history, kind of recapping. 3 different bureaus, different credit models. FICO is the one that most housing defaults for. There are other models like Advantage that cover different areas, and then of course some additional one-offs that people use for certain programming. Within each bureau, there's different levels or versions. So version 8 versus version 4 for TU can vary in the scoring. And then, of course, you can do different programs with Experian that allow you to rescore to get additional things to count towards your credit profile. Just be mindful of the options when you are making decisions. Credit usage, utilization, payment history, credit depth, what types of credit you're doing, and how long you've been doing them for, and then of course variety of credit, and how much you're using with it. So a lot of it goes into it. Length of accounts also plays a huge factor in it. How long you finance things for, how long your oldest account is, etc. If you have a bunch of new accounts, even if you might score high, it's still going to be a huge risk assessment for lenders and institutions when they're looking at that stuff. But still good functions when you're looking at those things. So if you guys liked it, feel free to hit me up in the comments below. I want to try and do as much informative stuff as possible while not really breaking the bank, but I know it's super important to kind of cover the basics and really understand how it goes. If you loved my art diagram, I can send you a copy of it, no problem. If you have any more qualifying questions or questions that you want specifically about those programs, feel free to hit me up. Thank you.